Thanks so much for joining us today. I'm Lee Martinson, Customer Success Manager here at Snap Projections, and I have two of our senior customer success specialists joining me today, Anu and Jennifer. We're very excited to be hosting this webinar all about providing tax planning guidance and clarity and transparency using Snap Projections. So let's jump in. So first of all, to submit questions, please enter these in the Q&A area. We'll try to answer it live, but if not, then rest assured we'll get back to you by email over the next few days. And this webinar does qualify for one FP Canada approved CE credit. So how this works is tomorrow, everyone who's here today, they'll receive an email with today's video recording. You'll also have a request to enter your name and email in a submission form, and that is going to be used to request your CE credit. We'll send out the certificates by March 31st. And just a note that in order to receive this credit, you do need to have attended this session live today. So if you're watching this in the future as a recording, then unfortunately you won't be eligible for this CE credit, but please join us in a future session. This is going to be a full session today, so it is good that we're recording it and you get a chance to come back to it in the future. What we're going to talk about is optimizing financial projections for both younger and older clients. I'll go over some of Snap's new features. Also, one that was released a little bit ago called Taxable Income Targeting. We'll be comparing scenarios, looking at a report, and we will try to save some time here at the end as well for some questions and answers. Today's first example client that we're going to talk about is Sarah Clark. She is planning to purchase her first home in 2031. And right now she's saving into a TFSA for the down payment. So I just want to give you a little bit of a summary here of what's going to happen in the year of the purchase of the home. Sarah is planning to buy the house that's going to be worth $550,000, estimating closing costs $20,000. So the total that's going to be required in 2031 is $570,000. She is planning right now, she's saving into a TFSA, so she wants to have a $100,000 down payment made up from what she's already saved, which is $65,000, and then also saving $8,000 a year until she purchases. She's lucky to be receiving a parental gift in the future year of $60,000 towards her house, and that leaves her with $410,000 that she'll need, which $400,000 of that can come from a new mortgage, and only $10,000 is left at that point, which we're going to assume will come from cash flow that year. So in that year, she won't be saving towards the house any longer in the TFSA, so that'll save $8,000. And then there'll be a couple thousand that can come out of her regular cash flow. So I just wanted to show you that first because we're going to be using this information in Snap Projections as we get started. And so far, so good. Anu, anybody having trouble with seeing my screen? Am I good to get started?
Everything looks good so far, Lee.
Okay, perfect. So what's interesting about Sarah's case is that she was unaware of the option to use the first home savings account. And that is what we want to show her the benefits of today. So I've created a basic scenario to start with. This is just in the interest of saving some time rather than entering all the information with you on the line. I've got the scenario setup details already started, and we'll review them together. So this is her home purchase in 2031 with TFSA savings. I'm not sure if you're aware, but you can click on this little settings icon. This will jump us into scenario setup. The second icon takes us to the planning page, and the third one takes us to the client report. So that's just a quick way to get into different parts of your already created scenarios. So Sarah is 35 years old right now, and we're going to be showing her projections until she's 100. So we're going to be looking at both the home purchase and retirement. She currently lives in Ontario. And as I move through the scenario setup pages, here we have starting the projections in 2026, retiring at 65. And then we're using the general default inflation rates which come from FP Canada's guidelines. You can always take a look at the top here for what is this to see what those projection assumption guidelines are and find out more information. So we're using the 2.1% inflation. Rates of return for cash, fixed income, and equity. I've used their guidelines but reduced the percentages based on management fees. And then at the bottom, you have a defaults button. You can always save whatever your settings are for new scenarios. And that way, you'll have your defaults already in input for you every time you get started. So next, I could either hit the next button to go to the next page, or along the top left here, you see that these are the pages that I'm scrolling through. So for base expenses, you can hover your mouse over any of these little question marks to get extra information. This is the amount that Sarah would like to spend in her retirement, $60,000 a year after tax. And we also want to enter that additional closing cost, additional expense in the year of the purchase of the home. So we have closing costs of $20,000. We're not using any inflation here. And this is going to be from the year she turns 40 to the year she turns 40, which is just a quick way of saying we want this to happen one time. It's a one-time expense in 1 year. It's happening every year, but it's just in every year between 40 and 40. So that's how we indicate that. Highlighting it, we're saying yes, which means in our cash outflow chart, instead of seeing the word additional expenses as our legend item, we'll actually see closing costs as the specific item. Okay, so next I'm coming into her income. So Sarah does have employment income of $145,000. We're indexing that at 1%. It is taxable income and RSP eligible going until the end of the year she turns 64, which if I select this little settings gear, it will show me the specific date. And this allows you to adjust for mid-year retirements if you wish. She's expecting that gift from her parents in the future year of the purchase, so $60,000 not being indexed. This is other type of income. It's not taxable, not RSP eligible from her age 40 to her age 40. So again, it's just 1 year. So next we have her assets, and Sarah currently has an RSP and a TFSA. The starting balance here of $113,000 for the RSP, and it's invested with 100% equity. Our TFSA is currently $65,000 and invested a little differently here with fixed income 50% and equity 50%. Then I want to take a look along the top of this financial asset table because we have extra information about the different accounts. So for TFSA, contribution room that's available for 2026 is $44,000. And again, this means that the maximum that Snap Projections would allow us to contribute to her TFSA in 2026 would be $44,000. It's not saying it will contribute $44,000, just that that is how much room she has available. And by default, you would see $7,000 there for your clients, and this is where you can adjust it if they have unused room. Next, we have her RSP contribution room. Same idea, $26,100 would be the maximum we could contribute in 2026, and the RSP is set to convert to a RRIF at age 71. I don't have any of the other types of accounts here, so we can just take a look at her house for her real asset. Because it's not purchased yet, the value is $0. The cost will be $550,000 in that future year. After that point, it will appreciate by 2.1%, and it's going to happen in the year she turns 40. We've updated this setting to be 2031, 12/31. So the very last day of the year, she would have purchased that house like by that time, and capital gain tax will be no. Next on the debts page, this is where that little slide is helpful that I looked at with you earlier. We're going to set up a $400,000 mortgage with 4% interest in that future year. Again, I want to make sure that I set it up to be the same as the purchase date of the asset. So this is the end of the year. She turns 40. Interest and principal will be paid as opposed to simply interest. Monthly payments of $21.50 a month, and this will help her to pay off that mortgage by the time she's retiring. It is tax deductible, no, for that setting. So keep that and linked to the house. And what that means is if we were to sell this property, uh, sell the house before the mortgage was paid off, then SNAP would automatically pay the mortgage off with the sale proceeds. Okay, next page. Government benefits. We have Sarah's Canadian pension plan. We're assuming 85% of the maximum, which is 26% higher than the national average. So when you first create a projection, you're going to see the value 59% in this cell here. So the percent of the maximum at age 65 on average for Canadians is 59%. And we just start with that default value for you. And this is where you can come in and make adjustments based on your specific clients. Sarah's planning to start her CPP at age 65 and the same as OAS. She will plan to take out some term insurance, so a term 20 when she turns 40 and purchases the home to cover the mortgage, so a $400,000 death benefit, $800 premium, and the estate will be the beneficiary. So we're almost through the scenario setup here. I'm not going to enter anything else. We don't have any RESPs to deal with or corporations. So that is all that we need to take a look at under scenario setup before we jump out here to the planning page. So I can just select that up at the top, and then I end up right here on what we call the planning page. And this example is great because it's going to show how useful this planning page is. We can see all the years of the projections for Sarah and everything, like how everything that we entered under the scenario setup comes into play here in her projections. I know it can be a lot of information to look at when you first come out to this page. There's a lot of columns, a lot of numbers, but let's take a look from left to right and help you get more familiar. So we have in the first year, the projections starting in 2026, she'll be 35 by the end of that year. And then we have this base expense column with 101,490 is currently displayed for me. And this is calculated automatically for me from the software by looking at all the income that's coming in and then subtracting all the expenses and taxes. And then this is what's left over, 101,490. And we're assuming she spends all of that on her lifestyle in that year. So here's her employment income, $145,000, and doesn't receive any CPP and OAS at this point. That's going to come when she retires. We have her taxable income listed, her contributions to CPP and EI, total taxes that are paid that year, her marginal and effective tax rates, and then we come to the financial assets section. So here, this is where we're responsible to enter any contributions or withdrawals in this period of the projections that we call the manual cash flow management period. So by default, there will be no contributions happening here to RSPs and TFSAs because we're in the period before the CFM start age. So this column here, this third column is called the start age. And that's the point where that $60,000 a year of base expenses that we entered under scenario setup will start. And that is the default. There are lots of videos and so on we can show you about changing this cash flow management start age. But for now, we'll keep the default, which is retirement, where we start entering the base expenses for that we desire for Sarah. So $60,000 in this future year. Nominal dollars, so 111,924 would be what would need to be spent in that year if we were spending the equivalent of $60,000 today. All of SNAP's calculations are based on this nominal dollar amount. Okay, so that was just a quick detour into cash flow management, but what I wanted to show you was that we're going to enter the contributions here manually because that is our responsibility before the CFM start age. So $18,000 a year to her RSP, and we're going to index that at 1%. Copy this down to her retirement, and you can see that it turns yellow, and that indicates to me that I've entered this value myself. So this is a manual, what we call an override, where we've overwritten the zeros that were previously here that the software had entered for us. She wants to save $8,000 a year to her TFSA, so that's going until she's 39 years old. And in the year of the purchase of the house, she's planning to withdraw $100,000. So I'm going to do a negative 100,000 just in that 1 year. And every time I make these adjustments, you see I made multiple changes. I can apply all of them at once if I come up to the run scenario button and click that button up here. And it had turned yellow because it was trying to indicate to me that I had made changes that I needed to recalculate. Now it's green, so we know that everything is up to date. So just continuing across in the first year here. So she's made $18,000 contribution to her RSP, $8,000 to her TFSA. The values of these accounts are the end of the year values. So it's after these contributions have been made and then after the growth has been applied. We have the real asset, which comes into play purchased in a few years at $550,000. The mortgage will start also in that future year, and it's just a very minimal amount paid because we started it on the final day of the year. Her life insurance and the premiums come into play. And then we have sections over to the right all about her estate and net worth. All right, so that was a lot. Let's go back to the left again and just see that base expenses have decreased now. And that is because I've made those contributions to the RSP and TFSA. So what this is telling me is she's bringing in $145,000 of income. She's making savings to her RSP and TFSA, paying her taxes, and what's left at the end of the year is $83,304, and we're assuming that she spends that money. In the year of the the purchase of the house, we have $77,777, which is left over, and it's quite similar to the year before, a couple $1,000s less, which is what we expected due to the fact she'd have a couple more $1,000s to cover out of her own cash flow that year. But this is the real power of the planning page. You can see everything that's going on. So she has the closing costs that year. She has the gift from their parents that's coming in. She has her savings still going for retirement. She's taking out money from her TFSA, buying the house, and getting the new mortgage, getting the new insurance plan. So it's all laid out for you, and we can understand what's happening from a cash flow perspective. Coming down later in the projections, we have her retiring at 65, at 65. And we're starting to withdraw some money from her assets to support her spending because she doesn't have quite enough in her CPP and OAS benefits. And if I scroll down to the bottom, we're going to be able to answer some questions that she's going to have, like how long is my money going to last? And how much could I spend so I won't run out of money? Or I'm currently saving a certain amount to my RSP. Is that going to be enough? How much will be left for my estate when I pass away? So all these questions can be answered quickly here on this planning page. One thing we can do is take a look at the estate before tax summary. So there's a little menu at the top of this column. And when I click on that, I see a summary for the final year. So we do see all of her assets listed, any taxes that are owed. So our final estate is positive in that future year. And today's dollar value, like sort of the equivalent of what $2.2 million would be when she's 100, would be $570,000 of today's dollars. So she is in a good situation here. Another way to find that out would be to look at the recommendations. And we can see that her goal status of $60,000 a year in retirement is overfunded. And if I click on sustainable spending, this would actually tell me how much more she could spend every year, which would be about $1,500 more a year. So we've used SNAP to show her that she does have balanced short-term and long-term objectives. She does have enough money to get to age 100 for her retirement, and it looks like that year of the purchase of the home, everything is working out well there as well. So I'll pause here for a second, and then we'll jump into creating a FHSA for her. But is there any questions, Anu, that I should be addressing?
Well, thanks for that, Lee. Great so far. Just one quick question on our scenario setup and assumptions. Why are we taking the equity at 5% where FP Canada can be a little bit higher as per the total equity return and the overall rate of return for this client?
Right. So in that case, like I don't know if it's 6.9% or something by default. I've just used this in the past. You can use whatever you'd like. You do want to make sure that you subtract any fees off of that FP Canada guideline. So that is important. If you look at the general page, we do indicate that you must subtract fees from the rate of return. So that could be one reason, but this was just an example.
Yep. Thanks, Lee.
Okay. So because Sarah was unaware of the FHSA option, which would allow her to get tax deduction for her contributions, and then the withdrawal from the FHSA would be tax-free as well. So we're expecting this is going to work out better for her. Actually, it's a good point. I can point out if you go to our help center up at the top right, you have different options here to get some help. But if I just jump right into the help center and type in FHSA, this is just an example of how you can get detailed information about various types of accounts that we have. There's a little video that would show you more, but this would give you a lot more detail about what we're about to do here. So under the assets, I'm going to add that FHSA, which is here, adding a financial asset. And I can just type that in. And it will be nothing in the account right now. We'll select FHSA from the options. And I'm going to assume the same asset allocation here as the TFSA so that we're comparing apples to apples. I have the FHSA header at the top where it defaults to her age right now. I can indicate $8,000 of carry forward room if I'd like. She's not made any contributions in the past. And I would like to link that to her house. So what we're going to be doing is putting in the savings into the FHSA. So there's a $40,000 maximum contribution, and it will just work out for us that we can make the same. These $8,000 for 5 years would be $40,000. So I can just put them in to age 39. And I want to remove them from the TFSA. Oh, I forgot to copy the scenario first. Okay, this is a second. This is what happens when you're trying to fit too much in. Let's clear this override on the FHSA, run the scenario. So everything is still the same. She has an FHSA, but there's nothing in it. So what I'm going to do now is copy the scenario. So copy the scenario. I'm just using this menu up at the top. And the reason I want to copy it is that, like, I could do it on the original, but I want to copy it because I want to be able to show you that there's a difference in the second version. So in the FHSA copy. If I made the changes in the original, there would be nothing to change, compare back to. So I'll make the changes here in the copied version. So I'll just copy this to 39. And I will remove from the TFSA. So to remove what I've put in as an override, I want to use this clear override checkbox. And I'll just clear everything out of the TFSA column. Make sure to run the scenario. So up at the top right again, I have to run that scenario to make sure that all the calculations come into play. And we see automatically a withdrawal here from the FHSA. So this $43,115 automatically is withdrawn because the software knows that she's purchasing that house, and I'd link the FHSA to this house. We will need to take some money from her TFSA because we had a $100,000 down payment before, and we want to have the same down payment now. So the difference between $100,000 and the $43,115 that is coming out of the FHSA is $56,885. So if I enter a negative number, 56,885, and run the scenario, then everything should be the same as the original for the withdrawals. So again, we're still at that 77,777. That is exactly the same as we had before. She's making a $100,000 down payment. So what the difference is going to be is in these earlier years where she's receiving a tax deduction for these contributions, and she wouldn't have received that for the TFSA contributions. So how can I see that information? Well, one way is to go up to the taxable income menu. And we've always had this table, so this is not new, but just to point out that you can see the details here. So deductions in this case are going to include her RSP contributions, her FHSA contributions, and her additional contributions to CPP to do with the enhanced CPP. And so the total value of all the deductions is listed right here. But sometimes it might be like a little bit unclear. You're like, well, which of these deductions listed here in this question mark are applicable to Sarah? And what we have now is a fantastic new feature where I can look at the income tax in any given year. So if I click on this value here, this 26,454 in the first year of the projections, and I can click on it for any given year, but I'm just choosing the first year, we can see this T1, the total T1 is here with sections, the line numbers, amounts of all the different items here. We have the federal worksheet, we have provincial worksheets and taxes, we have different schedules. So there's so much information here that you can dive in and really get clarity on the taxes owing each year. For Sarah, in her case, she's got her employment income, and here's those deductions. So the RRSP deduction, the FHSA deduction, and the deduction for CPP enhanced contributions. So there we go. It's very clear what those deductions are. And any given year, like I said, you can click on that value to get those, the taxes. One thing to note is that this is all in nominal dollars, so it's all in like future dollar amounts. All right, so we still need to answer the question of, you know, how do we show Stacy that this is a better scenario for her? So we're going to use the compare scenarios option, which is up at the top. Again, I select the 3 lines here, compare scenario, and I want to compare the 2 scenarios. So the home purchase in same year with FHSA or TFSA savings. What I'm selecting to compare is all of the years from age 35 to age 40. So I'm just going to exclude all of the later years because really what I'm focused on, the difference is just those first 5 years where we've made that change from FHSA contributions. What we can see is lifetime expenses. So in the TFSA savings and the home purchase, there's a little bit of a different amount. So 16,822 more lifetime expenses in the version with the FHSA. Where that comes from is the fact that the version with the FHSA here has less taxes owing between age 35 and 40. So 16,821 less in taxes, which is then available for her to spend on her lifestyle. So she has an extra almost $17,000 that she could spend, which is what's happening right now in this scenario. But then you could have a discussion about maybe you want to save more, and then you can adjust the scenario and say, well, since you're saving that money each year, maybe we'll save more into the TFSA, for example, because you're receiving that tax deduction. So it's a great way here. We've just shown her a benefit working with us. You know, you were going to save in your TFSA. We can show you that you're saving $17,000 by using an FHSA. So that's the end of the topic about Sarah and her house purchase. So I can pause here again just to see if there was any questions before I move on to our next client.
Hi, Lee. Well, thanks for showing us that and especially the FHSA account. Just a quick question. I don't know if you'll have the time to actually illustrate it, but can we also use home buyer's plan under RSP to take money for the home purchase that Sarah is doing in this case?
Yeah, so we can, and we actually have an article all about home buyer's plan, which walks you through the steps. I do have another version that I did try that out for. I don't think we're going to have time right now to go into it, but if we have time at the end, I will open it up. And if we don't have time, then what I'm thinking about is one of our next Q&A sessions. So if you are in our help site and you take a look at our webinar section, we have some live support sessions here, and we can make upcoming session all about continuing from here. So we can show a home buyer's plan for Sarah in this case.
Awesome. Thanks, Lee.
Okay. And we may have time at the end, but I know that I have a lot to show you because I'm so excited about all these new features and trying to put this together, it was like, wow, there's so much I want to share. So hopefully I'm not going too fast for everybody, but yeah, you can let me know. And we can always, like I said, go into more detail in in our next Q&A session. So I will start here for our next couple, which is Stacy and Greg Roy. So this is a couple we wanted to show a little bit more information about, not a younger client, but someone who's just approaching retirement, and they are hoping that they're on track to retire in 2 years. They want to spend $90,000 a year on their lifestyle in retirement and also some additional travel. So they're both 58 years old, planning to retire when they're 60. And we've used the same default settings here for inflation and rates of return. Under expenses, we'll see that we have their combined annual amount is $90,000 and that additional $10,000 a year of travel between the ages of 60 and 69. Now that we're working with a couple, under the scenario setup, we do have 2 pages. So one's for Stacy, one's for Greg. Here's Stacy's employment income of $122,000, 519. And then if I click on Greg, I'll see information for him. So he has $91,889. We'll go to their assets and take a look at Greg's assets first. There is a joint non-registered account that their value currently is $236,000. This one is allocated to 30% fixed income and 70% equity. And then Greg has his own TFSA, RRSP, and a DCPP. So if I take a look at his TFSA, we have $7,000 of room for 2026 to contribute. And we've also selected another one of our new features, which is the ability to maximize the TFSA contributions by moving money from a non-registered asset to do it. And Snap will do that for you automatically. If Greg didn't have enough money in his non-registered assets, it could also use non-registered assets from his spouse. So we've set this up for both of them, that we're going to maximize the TFSA contributions for this scenario. We have his RSP, which is converting to a RRIF at 71 and has 16,200 of room. He does have a DCPP, which we've selected the jurisdiction of Ontario, converting it to a LIF at age 59. So the LIF income will start when he's 60, and we're unlocking 50% of it to his RSP. Oh yes, also he has some employer matching. So because he has that DCPP, we've linked 6% employee contribution and 6% employer contribution to his employment income. They do have a house as well, so that is currently valued at $765,000. Initial cost $450,000, and it is a joint asset. So if I jump back over to Stacy, we can take a look at her assets. She also has the joint non-registered account and her own TFSA and RSP. Her investments are slightly different. Fixed income 30% and equity is 70%. Next, we have the debts, and under the debts, they have this mortgage, which is nearly paid up because they're putting down $2,500 a month, so they'll be paid off within the next couple years. Interest rate of 5% and linked to the house. So this is a joint mortgage, meaning they will each be responsible for half of this monthly payment. Under government benefits, we have Stacy expecting 80% of the maximum starting at age 65. So even though they're retiring at 60, they're going to wait on their government benefits at this point to 65. And Greg is expecting 75% of the maximum, again, waiting until 65. I don't have any other details under scenario setup for this couple, so I will just jump right into the planning page. Now let's take a look at Greg's details here, because I want to just point out that how this TFSA top-up works. So we have $7,000 of TFSA contributions, jumping up to $7,500 in a few years, because we assume that with inflation that the contribution maximum for each year will go up by $500 as we reach the nearest $500. So you'll notice that there's some withdrawals that are happening here from the non-registered account. Now, when I hover my mouse over that, it shows me that is a transfer of 7,227. So the amount that's being withdrawn from the joint non-registered account is actually a little bit higher than what is going into his TFSA. And we do see that it is a transfer going into the TFSA as well. So why is that the case? Why doesn't it just take out $7,000? Well, this has to do with the plan here is that we want to keep the base expense value the same for Greg, whether or not he does the TFSA top up feature. And this is because we're gearing up towards more future automated optimizations, and we want to make sure that we're comparing apples to apples. Like we want to say that they're spending the same amount of money, whether or not we've done these transfers or not. So we want to be able to say whether it is better for him to do the transfers or not do the transfer from his non-reg account. If I take a look at his taxable income that year, I can see that there are some, capital gains that are associated with that non-registered withdrawal. So that is why it is taking out a little bit more to cover the extra taxes that would be owed due to that withdrawal. He also has his DCPP employee and employer contributions. And then in retirement, SNAP is withdrawing from his LIF, and it's right now it's in between the minimum and the maximum, which I can see as I hover my mouse over that value. If I wanted to, I could force either the minimum or the maximum. And again, we have an article all about that, but it would just be a matter of putting in a larger amount. So for example, I could say take out $15,000 a year from that account. And if I'm trying to force the maximum, when I run this scenario, it will correct it for me to what it believes the maximum would be. So instead of what it was taking out before, it's now going to be taking the maximum amount. So that's just a little trick I just wanted to point out to you. But I will just revert that back to normal for now. And we'll talk a little bit more about those maximums shortly. So this is Greg's side. Now let's take a look at Stacy, and it's very similar. We're going to see the joint non-registered withdrawals. It's a little bit different for her just because her tax situation will be slightly different. She's at a higher marginal tax rate. And she has some contributions going into her RSP as well. So $24,000 a year is something that we have entered because it's yellow. So this is a value that I entered into the software myself. But their question is going to be, are we okay? So do we have enough money to retire at 60? And will we have enough money left at the end of the projections to leave anything to our kids? So again, there's multiple ways that I can do this. One way is I can just scroll down. Actually, I'm going to go to the combined page first. So the combined page is a great way to see everything all at once for the couple. And I can expand and collapse the different sections. So for example, financial assets up here, I can expand this out and I can see all of the individual assets as well. Or I can collapse it and then I see a total. So all types of accounts. As I scroll down to the bottom, they still have $559,000 here in this very final year, which is indicating that they have not run out of money. Or I can look at their estate before tax in that final year and see all of their assets, the tax on estate, what their final estate value would be in both nominal and real dollars. But the next question may be, where did this $55,000 in taxes come from? And in the past, we did not have a way to dive in to show you that number, but we do now. So first, let me just collapse this section because you may come into your projections and not see the column that I'm going to be talking about. What you'll need to do then is under balances, you'll hit the expand button, and that gives you two more columns here to do with the estate taxable income and the tax on the estate. So by clicking this value up at the top, this little menu in the estate taxable income, this is going to give me every single year of their projections and how the estate taxable income was calculated. And again, I can look at question marks to see more details about these columns. But what this is going to show me is the total taxable income that's calculated in the final estate. So this is on top of any taxable income realized in the calendar year that would have already been in the income tax section. And these values are based on events in the estate like registered withdrawals. So that's going to be the main income that we see here because they have some RSPs left, and I think Lira left as well at the end of the projections. Where this table will really come into play that could be quite helpful would be if there are larger non-registered assets, so we could see the capital gains that would be associated, or secondary properties with capital gains, any corporate distributions, etc. So we're going to have a lot of details in here for you to take a look at. And we can also click on the tax on estate and see those details as well. So here we have every year's federal and provincial tax, and then this recovery tax. So this is going to be corresponding to any OAS that was received in that calendar year that would be clawed back in the final estate. And those are all those details here. I guess one thing to point out is when you do have a couple and we're looking at the estate before tax, and remember, you can look at the estate before tax in any year of the projections just by clicking that year. So here we're looking at 2044. One thing I wanted to point out is we're assuming in this case that both Stacy and Greg passed away at the exact same time, like on December 31st, 2044. So in reality, if one person passed away, then there would be a rollover of assets, and we would do that for you if we were to adjust the end date of the projections for one of the spouses. And you would see the rollover of assets and insurance paid out and so on. But for this table, we're always assuming the date of death is the exact same for both people. So we're not looking at any rollover of assets in this case. Now, what else do we want to show? Oh, I want to highlight as well that we can still see their individual taxes. So if I go to Stacy's page, we're going to take a look at her individual taxable income. Now, if I look at Stacy in the year here where she retires, like there is a pension splitting amount. So $800 right now is coming to her from Greg as pension because it's being split from, I guess, his LIF income. So she's receiving $800 of taxable income. If I want to understand a little bit more about that, I can click on her total tax in that year, and I can see that there is this elected split pension amount, and we're also going to be giving her $800 towards the pension income amount as well. So this helps me dive in to see, what exactly comprises her taxes that year. And another thing that is recently changed in the software is that we are now going to be classifying withdrawals from RSPs between the ages of 65 and the RRIF conversion age as RRIF income. So we're not actually converting the entire account to a RRIF, because you can see here as I hover over her RSP withdrawals that it is still considered to be an RSP. So there's still, contribution room. Whereas if I look down at age 72, when it's considered to be a RRIF, we're going to see a minimum withdrawal amount that has to be enforced. But before that year, she does have some RSP withdrawals. And what we're going to assume is that there would be like a small RRIF conversion where we would convert a small portion of her RSP to a RRIF and then withdraw it from the RRIF right away. So this $43,195 that comes out when she's 68 years old, if I look at her taxes that year, it's going to be classified as pension income. So this is, instead of considering it just as other income or like RSP income, it's going to be considered as pension income, which will allow it to be eligible for splitting as well as for the pension income amount as well. So that's just something to highlight, that it will be changed now in your scenarios as well. So if you go into one of your existing scenarios, anytime you see RSP withdrawals in between the age of 65 and the RRIF conversion age, these will be considered for tax purposes and for pension income splitting to be RRIF income. And this should improve the client's projection accordingly. All right, so we're at 45 minutes here, Anu, and I want to show the taxable income targeting, but let's just pause here for a second to see any questions.
Well, great going so far, Lee. We're getting some really good questions as well, and Jen and I are trying to answer them. So just one quick thing, if you could show us how their plan for Stacy and Greg's gonna look under the charts.
Sure. Okay. Great question. So we have, I'm going to the combined page because you can see charts for both Stacy and Greg individually as well. And I can access the charts right here from the planning page. You can also get to them from the report. But right here from the planning page, we can see the cash outflow chart. And it is actually really helpful. You can hover your mouse over the different items to highlight them. And you can also, what's great on the cash inflow chart is you can actually, on all of them, you can just deselect everything if you wanted to tell a little story. So if I was wanting to explain to them, where's your money going to come from, in retirement? Well, at the beginning, you have your employment income, and then we start with your OAS and CPP, but not to your 65. So before that age, you're going to have some LIF income, and so on. So we can just show all of that information. The tax situation here is really great to look at because we can see with the default strategy that SNAP starts with, which is withdrawing from non-registered assets first, and then TFSAs, and then registered assets. We have this low tax area between 60 and 66, 67, and then the taxes are going to go up. And that's what we're going to see if we can improve on in the next scenario. In the net worth chart, we can see that their final net worth is mainly made up of their house, but they do still have a little bit more in their assets in that final year as well. And then we have an asset allocation chart, which you can update for different years and decide if you'd like to include the real assets in the chart as well. And then you get this little pie chart for you. So I will take a look here at Stacy's tax rates because we have, like we saw in the chart, there's higher taxes when she's working, and then we have this lower time period where there's lower marginal tax rate, and then we have it jumping up, and it goes up to the 23.15% marginal tax rate at some point as well. So I'm going to copy this scenario. Well, actually, the other thing I wanted to point out is that the default order, so if I wish to show you the order column for this scenario, just by clicking on that settings gear at the top of the financial assets and saying, show me this order column. For withdrawals, the default order that you'll start with is non-registered first, TFSA, and then registered. And that's what we see happening, non-registered assets, TFSA assets, and then registered assets. And this is based on the fact that we're deferring taxes as long as possible. And that strategy has been shown through research to minimize the chance that the client will outlive their money in the majority of client cases. So it typically works quite well, at least as your starting point. And then if we want to make some optimizations, we can copy the scenario and see if we can do that, if we can optimize it for them. So we will do a copy of a scenario. And in this version, I'm going to employ one of our newest features, which is called taxable income targeting. So what we want to do is have more of a blended withdrawal where we'll have some non-registered money, but also some registered money. So I'll just call this taxable income targeting. And I just clicked on the name here to edit it, and that's all that you have to do. I'll take a look at Stacy, and I want to turn on this new feature. So if I take a look at this taxable income column, there's a little gear. And again, make sure if you have collapsed this section, you're not going to see that. So you want to make sure you expand the section. Then you'll see a taxable income column with the gear. I'm going to enable this targeting in this scenario, starting at age 60, and save that. And what this is going to do is give me a new column, and the new column is going to be called my target taxable income. It starts off with the same amount that is in the actual taxable income, which is what we saw before. What do we want our target to be? Well, there's different strategies, and I would point you to the article again to talk about a few of the different strategies, but one of them could be here. We want to keep her under this 19.05% marginal tax rate, and this is just the Ernst & Young combined federal and provincial personal income tax rates for 2026. So this is showing me that for Ontario, if we keep her taxable income under like $53,891, that she'll be in this 19.05% taxable marginal tax rate. So using that number, I'll go back to my planning page, and then I'll just put in the amount. So let's see. We'll use 56. We'll use 53,800. So it was 893 or something like that. So 53,800. I'm going to copy that to Greg, to her spouse. So we'll have the same target for both of them. I'm going to copy that down to age 100. And I'm going to say that this is in real dollars. So in 2026, the value is 53,800. We're starting in 2028. So once I hit the select yes button, that 53,800 has jumped up to 56,083 based on my inflation. And I will just run this scenario here. And then the goal again is to smooth out the taxes. We're going to have more taxes earlier on, yes, but hopefully in the end, that's going to mean that it's a better scenario for them. So if we look down here, it's 19.05% taxes the whole way for the marginal tax rate. And we do have these RSP withdrawals that are happening earlier on than they were before. If we look at Greg, it's going to be very similar in that he also will have this 19.05% marginal tax rate. And remember, in the past, we had to force the maximums from the LIF. If I just hover my mouse over this, we're going to see that it is already taking the maximums for us. So maximum 57.15, and that's what's coming out. So it's taking more registered money up front. If I look at the chart again, back on the combined page, we'll see that in that second chart, if I go to the taxes, it's a lot smoother here. So in the early part of retirement, we do have more taxes, and then it will actually drop down to very low at the end. But the question then is going to be is this better for them or not better for them? So one thing that we can look at is the comparison. If I come up to the top and say compare scenario, I want to look at the base scenario with taxable income targeting and the base scenario. And we'll get this table again. Now I'm looking from their current age until age 100. And at the end of the projections and their goal of spending $90,000 a year, they're reaching their goal in both cases. So that is not changed by age 100. They're spending here the same amount of money in both scenarios, which is good. We want to compare like scenarios. Their expenses are the same, but their taxes are lower here in the one with taxable income targeting. And their final estate looks a little bit different in that they have less in their financial assets, but they also are going to have like no taxes owing here on their estate, whereas in the other version they did. So the difference in the end, at age 100 is very minimal, like only $37,000 better off here with this taxable income targeting strategy, but that's at age 100. So let's take a look at the trends, and that's going to show us year by year in a chart format to see which scenario is better in any given year. So here's their base expenses that are the same all the time. We can see the taxes here. So this is with taxable income targeting, higher taxes to start with and then lower at the end, whereas the base scenario had lower taxes to start with and then higher at the end. But the main factor we're going to look at is our estate after tax. So looking at the taxable income targeting scenario here, if I highlight that one, it is better in all years than the base scenario, like that their estate after tax is higher in all these years. And it's not until the very end here that they become closer together. But for example, if they were to pass away, in their 80s, you can see there's a bigger difference in those years. So this is a way that you could show your clients the strategy if leaving a higher estate after tax is something that's important to them, that this strategy would work that we implemented. You can print this up at the top here. There's a print, and you could save it to PDF as well. And then if you wanted to show them in a client report, you wanted to put it all together, we can run this recommendation to say how much more could they spend if they can spend 90,000 is like how much more could they spend, and then this is going to flow through into my report for me that I've calculated this value. And yeah, we're really close to the end here, so only 5 minutes left. So I'll just show you overview quickly of our report. And Anu, if you want to ask me any questions, um, just they could spend $3,400 more.
Yeah.
Client report, I'd already kind of set up using one of our templates that we have in our help site. And what this would show you is that we can have sort of an executive summary, which indicates like what they're currently doing, that they're on track for their goal, what their net worth is going to look like at the end of the projections, uh, what they should be saving in the next few years, and then all of the assumption details. And we're diving into like the charts again, any other detailed metrics, and at the very end, we can give them some recommendations. Okay, so what can I answer in a couple minutes?
Well, Lee, again, great information, and thanks for everybody who's been asking us all these questions. If we are not able to get back to you within the next 4 minutes, we'll be happy to send you an email for any of the questions. Just last thing, Lee, how can or if you could show us our new feature for AI import assistance, and how can we navigate into it?
Perfect. Okay. So AI import assistant feature. So this is, yes, brand new. If I come out to my clients page and you'd see actually if you clicked on help and what's new, this is going to give you details all the time about something that's just come out you might want to check out. What we can do is select this import anything with AI. So what the AI import assistant does is it starts a projection for us, just the scenario setup details. So it's going to take whatever you've imported and use that to create the scenario setup information for your projections. To use it, you're going to need to accept the terms to start with. And I'm just going to jump over to the About This page up at the top right, which is our article all about this feature. It will accept various types of documents. Great ones to use would be a completed client questionnaire. You can use like account statements and so on. Different file types will use up more of what we call your credits. So by default, every user is going to have 10 credits a month, which equates to about 4 to 8 uploads. So you should be able to, create about maybe 5 new client projections, scenario setup data using this free credits. If you potentially wouldn't need to import more, then you can purchase more credits, and that's all detailed in here. But what happens is once it's imported, we'll give you a summary. So there's a generated summary that will tell you information about what was imported, what maybe it had trouble importing, and things that you would want to, like things that were missing from the uploaded data, assumptions that it had to make in that case. And you would just access that from the notes right here. So you'd want to definitely go through and, look at those notes and then look at the scenario setup, but that's what you would be doing potentially anyway, even when you enter your own scenario setup data, just to confirm everything is correct.
Thanks for that, Lee.
All right, well, I guess I'll close it here, but just as a reminder that we are currently building tools that are going to help streamline the optimization process. So I showed you some examples today of how you can optimize. We created secondary scenarios to compare and create even better outcomes for clients. And today we looked at taxable income targeting, automatic TFSA top-ups from non-registered assets. We talked about RRSP withdrawals now being classified as RRIF pension income between the ages of 65 to the RRIF conversion age. And all of this is like, we're moving ahead to create more automated tools that are based on all of these features. So we're going to continue to prioritize everything being customizable and transparent so that you have final control over any automated tools that we do develop. But I really appreciate everybody coming today. Thanks so much. It's great to see so many people here. And we're excited to help you. So dive into some of these tools, reach out to us, and we will get back to you as soon as we can and help you as much as we can.
Awesome.
So thanks for coming.
Thanks for all of that, Lee. Just the last thing, if you could share your feedback with us and also what more topics you would want us to cover in our next Q&A session or in one of these webinars as well. Thank you.
Thanks, everyone.